Hi there, good afternoon. I'm Mangla Malu. With me is Sumaira Abdi. This is the Mutual Fund Corner. This show assumes more importance today given the happenings at DHFL and the repercussions of the same on all the other financial stocks today. Add to that, there was no surprise, no positive surprise coming in from the RBI policy, and then there was a spate of profit taking which is now exacerbating, and the markets now lower by almost 1.25%, 150 points shaved off the Nifty, nearly 500 shaved off the Sensex, almost 700 points, 650 points if you must, shaved off the Nifty Bank. What we do is take a look at all the top stories that we're tracking and then hand it over to Sumaira. She has a fair amount of mutual fund related queries. Market falls further as contagion fears from the DHFL crisis worries investors. The Sensex and the Nifty trade over 8% lower, near the lows of the day after the RBI acts on expected lines. Banks take a knock, with the PSU Bank index lower by almost 4.5%. The Reserve Bank of India cuts repo rate by 25 basis points and changes its monetary policy stance to an accommodative one in a unanimous decision coming in by the Monetary Policy Committee. The central bank says there is scope for the MPC to accommodate growth concerns by supporting efforts to boost aggregate demand and reinvigorate private investment activity. Crisis deepens for DHFL as ratings agencies downgrade the commercial paper rating to default grade after the company misses a deadline to pay 1,150 crore rupees to the NCD holders. CNBC TV18 learns that DHFL may look to sell part of its portfolio to banks to make up for the shortfall. The Reserve Bank signals its intent to intervene should the NBFC housing finance issue pose a systemic risk. The governor says central bank will not hesitate to take any steps needed to maintain stability. GAIL tops the Nifty losers list with an over 10% cut after the PNGRB hikes tariff for its Hazira, Vijaypur, Jagdishpur and the HVJ upgradation pipeline, but the hike is much lower than what the company had applied for.
Mangalam, thanks very much for reading out the headlines. As you can imagine that we're in a rush to get started today because, over the last 24-48 hours, a lot of investors have expressed concerns about what to do with their investments in light of the delay/default, as it's being termed by housing finance company DHFL. So it's the rating itself has been downgraded on the CPs now to about D. And Kaustubh Belapulkar of Morningstar India joins in to tell us how retail investors should go about handling this in their portfolio. So Kaustubh, first, of course, is that immediately we saw the NAVs of a lot of funds coming down, some from 3 to 50%. What does a retail investor do who has seen that overnight their NAVs have dropped so sharply? I mean, I know that there isn't much choice left and there are no easy answers here, but what is it that you would recommend?
Right. So I think the first thing I would say is that step away from all this noise. And I know it's concerning seeing such a sharp drawdown in an asset class that you would expect to be reasonably sort of less volatile, and you would think that your capital is reasonably safe, and you've seen some really sharp drawdowns like you mentioned. But I would say that just step away from that noise, and I would seriously advise that don't press the panic button. Yes, there's been a markdown, but I'll just take it back to September last year when sort of ILFS crisis panned out, and then DHFL name started doing the rounds, and we've had a series of downgrades for the bond since the start of this year, and now it's come to D. But if you just look at the track record of what the company's been doing, they've clearly been looking to monetize assets, and they've actually paid back a fair bit of capital back, and obviously the endeavor from the promoters is to continue to do that. Now they've missed this interest payment, and that's what's kind of led to the bond being put into the D bucket. But I would say that the intent still very much over here.
So even if you don't doubt the intent, the fact is that the delay has happened, right? So rating agencies have brought it down to D, and therefore mutual funds have no choice. Yes. So whether the intent is there or not is not in question at the moment. The event has happened. The problem now is that these are retail investors who have suffered through IL&FS. They continue to suffer through the SL Group woes, and now there's DHFL. So naturally, the next question on their mind is, what's coming next? I'm already losing money in, these three. Are there more skeletons?
Okay. So I don't know if I can comment on any more skeletons, but just to address that question again, if you just look at the DHFL bond and the sharp markdown that's happened on that bond, right? And I'm not denying the fact that there could potentially be some more names that may crop up. We don't know. I mean, that's something that the credit rating experts would probably throw more light on. But the sharp markdown in the NAV, which has been precipitated by this delay in payment, basically means that there's a notional mark to market that's happened on the bond, and it's pretty sharp, right? I mean, a haircut of 75 to 100%. Pretty much the bond's valued at next to nothing. If you exit today, you're kind of converting that notional loss into an actual loss, and mind you that there's no two ways about it. When you book that loss, if you exit the fund, that capital is lost forever. Now you're at a crossroad that, do you kind of stay put in the fund that probably had exposure to the strategy, and do I wait out the time? And that's the point that I was trying to make, that given that the markdown's already been pretty severe and it's happened, and there is a sincere amount of effort that's been going on through kind of monetizing assets, and probably a little bit of a mismatch that's happened. There's no denying that there could be further delays in payments. That's possible, right? Because I mean, this is a pretty tricky situation where they're selling down portfolios, they're getting strategic investors, they're selling out stakes in certain companies. So there's no denying that you can have potential situations like this again. But right now, because that loss is already there, your further loss, at least on this bond, is quite limited.
So a notional loss is better than a real loss.
Absolutely. I mean, that's what I would say, right? So, rather you wait it out, because you've come in with that, a certain time horizon. I know it sounds...
Yeah. So actually, I know. I take your point that for the moment, stay put, because there really is no other real choice out there. Now, should DHFL make good this payment in their grace period, which is what they say, can the NAVs be revised back almost immediately?
Okay, so that is actually a very interesting and a slightly tricky part when you look at it, right? So the drawdown or the markdown is pretty sharp. As far as I understand, the way it works is that the mark back up is not going to be as dramatic as possible. It's going to be more graded, because when you mark down something because they missed a payment, you need to have enough visibility and enough sort of demonstration by DHFL itself that they continue to service both interest and
they have further redemptions coming up.
Absolutely.
Later.
So that's going to continue to happen.
June.
Yeah. So even the rating agencies are going to be kind of watching the hawk eye, and they're not going to be in a hurry to start grading that back up again. What can selectively happen, and in certain funds where the maturity is coming up, there obviously, if the bond gets paid out on maturity, then you kind of realize your entire value. But a lot of the bonds are probably going to be maturing a little later down the road. So I wouldn't bank too much on that. But like I was saying, it's going to be more graded. So you have to be patient. I think that is really now the rule of the game, that the markdown's been sharp, but the mark back up is going to take time.
Even if they make this payment within the 7-day grace period, your principal itself may still be at risk.
So at risk, because if you just see what even the rating agencies, so you see CARE also put out on the NCDs, and they're very clearly worried that liquidity issues still exist. So it's not really a solvency issue per se, but the whole ALM mismatch that exists. If you talk about just the next 3 months, they have about 10,000 odd crores of repayments that they need to make. They're currently visible about 6,000 odd crores that they can pay out. So there's still a shortfall of 4,000 crores. So clearly liquidity is something that they're going to have to be on top of, and that is definitely a sort of issue that's coming out and again. So but they will obviously look to address it through various mechanisms. So there might be a further delay in payments. Like I said, that's something which is obviously can and will likely probably happen, but you just have to ride the wave, because unfortunately there's nothing else that you can do at this point of time.
Okay, so and it's not just investors who probably have redemptions coming up. Here's an interesting query. It's come from Charu Gupta, who's written to us on email. So she has some non-convertible debentures by DHFL, 150 of them, which currently she says she's facing staring at a loss of 40%. Now, this is a secured NCD which matures in 2023 with an annual interest of 8.9%. So she wants to know, as things stand today, what could be the possible fate of this NCD?
Yes. So again, that's that's almost.
I mean, as things stand today, I mean, things change in the future. That's fine.
So I think as the first important thing for us is to acknowledge that there is a kind of notional loss that's there, and more importantly, as a pure NCD holder, trying to sell it on the open exchange is going to be extremely hard. I mean, even if you were to go down that path, I don't think I would recommend that path, because again, maturity days are a little way down the road. Hopefully they'll start repaying the interest or pay the coupon that I don't know if she's in the half yearly or the annual sort of option, but if that continues to happen, so that should at least take care of her sort of needs in terms of the coupon. Once they start liquidating and paying back interest, that should happen. Hard to put a vision to what 2023 the roadmap will look like, but given just the size of the book, at some point in time, if things and I think even the RBI governor mentioned that they will, if need be, step in because you don't want to be. I mean, these are very important sectors for the industry.
I mean, DHFL is what, a 50,000 crore market cap company, so not small by any stretch of imagination. But Kaustubh, just finally to wrap things up, flows into mutual funds have been dwindling, right? I mean, equity flows are what just 3,000-4,000 crores as of last month. Let's see what this month brings. But surely this is going to dampen sentiments even further. Do you expect a lot more redemptions going ahead?
So unfortunately, I think yes, and we've seen that over the past 1 year, where clearly segments, credit risk funds, medium-term funds, where a lot of funds did have some credit exposure. That and it's a factor of two things. One is investors came in thinking that fixed income funds are reasonably safe, but I think that is where now we need to clearly make that distinction that credit risk exists. Is that suitable in your portfolio is something that each investor needs to assert. So I think that knee-jerk reaction to all the negative news that's been coming through has happened, and I think parts of it is unfortunate because investors have actually booked those losses, MTM and gotten out, and they'll probably take a long time to again come back. But again, my advice to investors out there is that this is a sort of phase that hopefully we'll tide over quite confidently. Let's just wait it out rather than pulling out money, like I said, add distress to valuations, because that's not going to serve anyone's purpose. Because what it does is it hampers your investment, and it also bloats the the investment of that that slightly dodgy paper in the portfolios of the investors that stay put. So I would say that it's in everyone's best interest that you just kind of stay the course.
For every fund that has marked down severely, there are funds and AMCs which have also managed to navigate this situation and have actually escaped without any sort of markdown this time, probably because of their own prudent investments. Kaustubh, thanks very much for dropping in and for breaking this down for our investors. Thanks very much. All right, with that.